So how can you know if a whole life insurance policy is a fit for you? Specifically, if you're interested in the cash value benefit. So 99.9% of people that our company works with typically express that they're interested in the cash value benefits of a whole life insurance policy. Meaning a big reason why they're taking that policy out is because they like what they see with the cash value. Looking at the cash value benefits, they see the safety, liquidity, and the tax benefits as well. Specifically being able to access that cash value tax-free. If they're in a high income tax bracket, those tax advantages become very, very attractive to them. Now, who uses whole life insurance and what are some reasons why? I'll talk about that a little bit today. What I want to start with is typically where people begin when they are working with us. Over the years in working with individuals, what we found is when someone engages with our company, meaning they say, hey, I'm ready to consider a whole life insurance policy or I'm ready to start one. When they state that, they typically have done research first, meaning they have a basic understanding of whole life insurance. They know that they want to maximize the cash value. A lot of times they've done research, they've spoken with other life insurance companies, they may have even owned whole life insurance in the past, but they looked at it or they see their policy and say, something doesn't seem right here. I'm giving the insurance company $1 and in the first year, I didn't get any of that $1, I had a 0. Or I'm giving the insurance company $1 and I only had 60% of what I paid into the policy in cash value. And I was told if it's any higher, it'll trigger a MEC, but it just doesn't seem right. So they understand whole life insurance, they understand the benefits, safety, liquidity, tax-free, but they're looking at the policy value and just scratching their head and really asking, can what I have now be improved? Meaning, can I give the insurance company the exact same dollar amount and I can have more cash value up front and more cash value long term? So a lot of times when we engage with individuals, they're at that stage. They've done research, they understand the product, they just want to make sure they get the most out of their money, which who doesn't want that? So number one, someone who's done research, they have an idea of what they're looking for, but they want to make sure they're getting the best deal possible. Number two, we'll see a lot of real estate investors and even business owners, someone who plans on actively using the policy. So a unique feature to the cash value benefit of a life insurance policy is that once a dollar passes through that cash value and you have access to it, you'll see it grow over time. It'll compound. The average growth rate over the life of the policy typically falls somewhere between 3 and 5%. Historically, we've seen some policies do a bit better than that, but just to be conservative, say 3 to 5%. And this is the net growth rate, the internal rate of return as time passes. In the early years, will always be negative even when we minimize the expenses as much as possible. So again, I'm interested in the policy for real estate or for my business. I'm interested in actively using the cash value. Once a dollar passes through that cash value, it's compounding for me, let's say at 4%. If I borrow against that cash value, I continue to earn, call it that 4% in this example, on my entire cash value. So pretend you've got $100,000 in cash value, it's earning 4%. Let's say 20 years down the road, it's going to be worth $300,000, just to make a number up. Today it's worth 100. You borrow $80,000 against that cash value. So you had 100, borrowed 80, you've got $20,000 remaining in equity, money you can still borrow. But the other 80, you've loaned it out. You still earn, call it that 4% on the full 100. Let's assume you pay it back 20 years from now. Do you remember what the value would have been if you just let it sit and grow? 20 years, we said $300,000. You pay it back by year 20. Guess how much it's worth? The same $300,000. You continue to earn that compound interest on the entire asset, even though you had money loaned out. Very similar to real estate. If I take a loan against real estate, if the fair market value of that property keeps on appreciating, the fair market value keeps on appreciating. So a lot of real estate investors and business owners are attracted to that because they know that they can put their money into this product, it continues to compound, but then I can borrow against it and use it as my own source of financing. Because eventually, as that cash value gets bigger from A, me pumping money into it, and B, compound interest, dividends and interest being applied to the policy, now I've got this big bucket of cash value where when an opportunity comes up, instead of going to a bank or a lender like I may have in the past, I can finance it myself. And unlike financing it with cash, which the money's gone, and then I eventually refill a bank account, the appeal here among many real estate investors and business owners is that it keeps on compounding. So now when I follow the same pattern of refilling my bank account, but I'm repaying this policy loan, what happens is when it's repaid, I see my cash value restored, plus the interest that it's been earning the whole time, even when the money was loaned out. So there's no lost opportunity cost there. That's very attractive to a lot of people that want to keep their money moving. So we've seen a lot of people take out whole life insurance policies and use their policies for other opportunities. And to get technical for a minute, what we always like to do in a case like that, when I'm actively using the policy, is prevent buyer's remorse. And how you do this is by looking at what the policy is growing by. We like to look at what it's growing by on a yearly basis, and then also the total growth as time passes, and then see how much we're paying in loan interest. This way I can see what's the cost to borrow, because when I take a loan, I am going to pay loan interest to the life insurance company. So if I'm using this for an opportunity, what I want to make sure of is that I'm not in the red. Or if I am, I'm aware of it, and how do I quickly get out of the red and make sure that this policy benefits me all the time. So we'll see a lot of technical buyers or engineers or people in the IT field that really like to dig into numbers, really analyze the product, and what we do is provide numbers on their actual policy so they can see that side by side. How much is my money growing by compared to how much am I paying in loan interest? So we like to look at that. And then the third type of buyer, people that are interested in whole life insurance, are typically business owners. And to summarize this answer a little bit more clearly, typically companies, small businesses and large corporations have always been attracted to cash value life insurance. And there's a lot of reasons why. One, when you look at the cash value in itself, it's a safe area to position money. It's an attractive asset on a company's balance sheet. It just continues to appreciate over time. It's liquid. I can access it like a line of credit. There's some business owners we work with that position boatloads of money into whole life insurance policies. When I say boatloads, 7 figures per year, and their plan is to get money into the policy and then loan it out for their business, perhaps real estate opportunities, but they're actively using that policy because of the liquidity, and they don't want to have to be delayed due to slow financing from a bank or something like that. That's often what is expressed to us. But the liquidity feature from a corporation or small business's standpoint is very appealing, and the tax benefits are very nice too. Now, there's a bit more than that. If you own a company and you've got executives, or perhaps you're a key member yourself as the owner, how you can set that policy up is where it's owned by the company, the life insurance is on you, and the beneficiary is the company. Or perhaps you have this for an executive. A company says, hey, I've got this superstar over here. They generate 40% of the company's revenue. If they're gone, man, I'm gonna be stressed out. I'm gonna have to go back and do the things that I hate doing that I had to do in the early days. This person is critical to my business. In a case like that, you may see a company take out a life insurance policy on this individual. This is a key man policy where the death benefit flows to the company in the event anything happens to that executive. However, there's benefits to both parties. The company will often set it up where the company owns the policy. The company funds the policy. They're paying the premium and PUA payments. The cash value is the owner's, so the company owns the policy, therefore the cash value is theirs. And then the beneficiary is the company. If anything happens to that executive, guess who gets the death benefit? The company. So there's a lot of benefits to the company there. What about Mr. Executive, Mr. or Mrs. Executive? Here's the benefit to them. What companies will often do, they'll say to this executive, or it's a number of executives, if you stay with my company for the next 10 years, or until you're 65 years old, or until what I like to refer to as the vesting period, which the company sets. If you stay with me for the vesting period, I'm going to pay you a retirement benefit. It'll be from age 65 throughout the duration of your retirement, and it's going to be $50,000 or $100,000 per year. Whatever the dollar amount is, that's all figured out before this plan is offered. But how this retirement plan is typically offered and paid to that executive or the retired executive is from the cash value buildup of the life insurance policy. So now, during the executive's working years, the company had key man insurance, they had the cash value, the executive knew that if he or she stays with the company for that vesting period, they're going to get a retirement benefit. There's pros and cons to both parties here, and there's a lot more to it. We've got case studies that go through how corporations use life insurance policies and such, but those are just 3 examples of who we've seen whole life insurance work really, really well for. Someone that's looking for a safe area to position money. It's a peace of mind product. It just continues to appreciate over time. I'm very attracted to the liquidity feature, specifically loans. I know I can borrow against that policy while it continues to appreciate for me. And then if I'm a company, I know there's a lot of benefits both to me and my employees or my executives that I elect to take these policies out on. So I hope you enjoyed this video. Let us know if you do, and if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.